The first question looks like coming from Stephen, someone who has a HECM, which is a home equity conversion mortgage, a reverse mortgage, with a $160,000 balance, also considerable IRA assets. Interest is accruing on the HECM. I guess 65% stocks, probably 35% bonds. IRA grows with the market bond portfolio. Should we pay down the HECM to maintain a smaller balance? Well, that's a question so within my research, it's something I look at. Generally speaking, the benefit of paying down the HECM balance is you move those funds back over into the line of credit. And then your future growth reflects more growth of line of credit instead of loan balance. That being said, though, I find it's generally not at all necessary to pay down the balance. You can benefit, like even in my research, I put in rules that if you're getting closer to later in retirement or if the loan balance is getting close to the value of the home, you do benefit from that non-recourse loan aspect where you're not on the hook to pay back more than 95% of the appraised value of the home. So if you're in that kind of scenario, you may not want to pay back the loan balance. If you have a smaller loan balance relative to the home value and you are thinking strategically, you could benefit from having more line of credit in the future, and you've been seeing good growth in your investment portfolio, then yes, it is an option to pay down that loan balance voluntarily to convert those funds into the growing line of credit. But again, it's not at all necessary. And I do see some further notes, 70 years old, hoping to stay in the house for at least 10 more years. I'd say there's really no single one answer to that question. It's not necessary, but if you'd prefer having that loan balance lower, more line of credit accessible to you, it's definitely an option available.
Okay. And wait, I'll hit the next question. It says, I hope to retire in, sorry,
Yeah, when
the
there's new
scroll went up.
questions, it
I hope to
scrolls around.
retire in 3 years at age 67. 950K in my 401k. Is there a reason to start moving money now out of the 401k and start creating my retirement buckets? Question mark. And then taxable or non? I assume accounts to put the money in.
Uh-huh. For you, the buckets don't refer specifically to I guess you could talk about buckets as like a taxable account, tax deferred account, tax exempt account. But usually it's more based on the time horizon for the spending, short-term spending bucket, medium-term spending bucket, long-term spending bucket. So you don't really just distribute funds from your 401k into a taxable account for the purpose of building up a taxable account. Usually the conversation around this is, do I want to do a Roth conversion? Do I want to move some of those funds in the 401k into a Roth 401k or roll over to an IRA and then move funds into a Roth IRA? That's certainly an option to consider. We would definitely need more information than just the IRA balance to be able to speak definitively on the matter. How much other income sources do you have? Do you also have a taxable account balance? Do you have a Roth IRA yet? Because you do need to have at least one open for 5 years before you can take a qualified distribution from it. But if this question simply, I want to start thinking about building buckets for my retirement income, that is a distinct question from tax planning around that 401k. And you can effectively create your short-term, medium-term, and long-term buckets all inside of the 401k if that's the appropriate direction to take.
Another angle I thought maybe when I was reading it, you could take, or somebody maybe thinking about it, and I'm curious what your intuition is on this, is, well, do they want to take money out of the 401k, pay like income taxes on it, and then reinvest it in a taxable account, and then in the future pay 15% on that? Or I would think intuitively it'd just be better to leave it in the IRA and not pay income on it, by taking it to another account.
Right. Yeah. Generally speaking, when we talk about tax distributions, like ordering of distributions, you want to spend taxable assets before tax deferred assets. So there wouldn't really be any benefit from intentionally distributing from a tax deferred account to build up a taxable account.